Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. I quite like the term bruised blue chips. It has a nice ring to it. I did not come up with this term though. Bruised blue chips happens to be the core theme of Motilal Oswal's latest wealth creation study. It is about how to make money out of bruised blue chips, which are struggling currently, not entirely of their own doing. Essentially, bruised blue chips are nothing but turnaround stocks. Hmm. Didn't Warren Buffett warn us against investing in turnaround stocks? Didn't he say that turnarounds seldom turn and that the same energies and talent are much better employed in a good business purchased at a fair price than in a poor business purchased at a bargain price? Well, Mr. Agrawal is not contradicting Mr. Buffett here. In fact, he is on the same page as the Oracle of Omaha. There are good businesses and then there are poor businesses. Bruised blue chips refer to those businesses that are good but are going through some near term challenges, a description that Mr. Buffett will have no objection to. In fact, any business that is part of the Nifty 50 plus the top 250 companies and has generated an average ROE of 20% for the last 10 years qualifies as a blue chip as per Mr. Agrawal. And what exactly turns a blue chip into a bruised blue chip? A blue chip that falls at least 50% from the top becomes a bruised blue chip. Yes, that's right. Mr. Agrawal and his team have come up with this minimum 50% fall criteria for the blue chip to qualify as bruised. Now, are there any such bruised blue chip in the market right now? Well, not quite as per Mr. Agrawal, but there are companies that are close to becoming bruised blue chips. Asian Paints, D-Mart, Tata Elxsi, and Berger Paints are amongst the most prominent ones. These stocks are down anywhere between 30 to 40% from their highs of the past few years and need some more correction to qualify as bruised blue chips. You see, blue chips need to fall at least 50% to qualify as bruised and for the risk reward to turn in our favor. Now, if the stock goes back to its original price after falling 50%, the returns become quite lucrative. If the stock goes back to original price in 2 years, the CAGR comes to around 40%. And if it does so in 3 years, the CAGR is still an attractive 26%. Even a 4-year waiting period gives a good CAGR of around 19%. Thus, since bruised blue chips very rarely go out of business or continue to languish at lower levels for long, investing in these stocks makes for a good risk reward proposition. Motilal Oswal's own study confirms this. They studied close to 100 bruised blue chips and found that every single company is still in existence, thus leading to a near zero mortality rate and a very low risk of permanent loss of capital. Therefore, it does appear that bruised blue chips is a sound investment strategy, especially in light of its ability to reduce downside risks. Now, although I have read a couple of interviews of Mr. Agrawal to gain a broad understanding of this strategy, I am yet to read the entire report. Hence, I am not aware whether the report helps you in putting together a bruised blue chip portfolio. The interviews only address individual stocks, and there is very little mention of how to go about constructing the portfolio of bruised blue chip stocks. While taking inspiration from this strategy, I have done a small study of my own, and the results have been quite encouraging. I am calling this strategy value blue chips. These are stocks that have earned consistently high ROEs over the last 10 years, thus making them blue chips and have valuations that are not very high. Thus, they are blue chips and have value in them, and hence the term value blue chips. Now, a back-tested portfolio of value blue chips gave an impressive return of 10x to 12x between December 2013 and December 24. In contrast, the BSE 500 is up only 4.7 times during the same period. Therefore, value blue chips has outperformed the benchmark index by a significant margin, and that too without taking a lot of downside risks. Here's how you can construct your own 20 stock portfolio of value blue chips. Each stock in your portfolio should have a minimum ROE of at least 15% in each of the last 10 years and should not have a PE ratio of more than 40 times and less than 5 times. These equal weighted 20 stocks are assumed to be bought and sold at the start of the year and end of the year, respectively. Then, a new portfolio of 20 stocks is created, and so on. If more than 20 stocks qualify, then choose the ones with the lowest PE ratios. That's it. There's no other rule. This simple strategy has returned close to 10x to 12x between December 2013 and December 24. Interesting, isn't it? Now, what will happen if I run the Value Blue Chip screener today? What are the stocks that the screener will recommend? Well, I have done this exercise for you and I'll share the names of 5 such stocks. Now, these are the names the screener suggested: Coal India, Kama Holdings, Mahanagar Gas, GM Breweries, and LIC of India. Some of these may not be large companies, but they are still blue chips because each of them has earned minimum 15% ROE in the last 10 years and they trade at reasonable PE ratios. Also, please note that these are not recommendations from our side and you are requested to do your own due diligence before investing in them. For this strategy to be successful, though, you should have at least 20 to 30 names in the Value Blue Chip portfolio. This will ensure a well diversified portfolio. Now, I believe the strategy works because it involves buying fundamentally strong companies with consistently high ROEs at reasonable valuations. And having a portfolio of 20 to 30 companies helps in diversifying risks such that few bad stocks don't cause big damage to the entire portfolio. Hence, if for some reason Bruised Bluechips is not your cup of tea, you can certainly consider Value Blue Chips. This brings me to the end of today's session. I'll see you again in the next video. Goodbye and happy investing.